right, ladies and gentlemen, it's Aaron Fragnito with People's Capital Group. We're going to get started here this evening. Hopefully everyone can see my screen properly. If you have any issues hearing me or seeing my screen, please type in the Q&A or the chat as we go along here. And we'll be talking about tonight our current projects here in New Jersey as we're working on New Jersey apartment buildings. And also, by the way, if you have any questions as we go along, I see more people are jumping on, which is great to see. If you have any questions as we go along here, feel free to type them in the chat. And the Q&A here, I really want to encourage questions as we go. I will answer all the questions in here so we don't get too delayed. But I encourage any questions. So with our passive investors that we're working on right now and how we help people invest in real estate here at People's Capital Group. So tonight's agenda is I'll talk about People's Capital Group a little bit, our business model, our mission statement as well, and our track record there. And we'll break into about 4 case studies here tonight. I'm going to be talking about an 11-unit mixed-use property in Summer Street in Paterson, New Jersey. This building was recently refinanced very successfully, doing about 2 times our initial targets to our investors there. So really big success story for our investors on that one. Case study number 2 is a smaller building, a 6-unit building in Passaic, New Jersey. We did about 1.5 times targets on that this summer as well. We did a refinance on that project also. Then I'll talk about a 25-unit in Paterson, New Jersey as well. Oh, look at that. So 2 properties in Paterson here. This is on Marion Street. And this is a nice loft-style apartment building that we are ahead of schedule on, but haven't got to the refinance yet. So I'll talk about that. 27-unit in Rahway, New Jersey. That's way ahead of schedule and why that one is really going to be a home run here. So we'll wrap up on how to qualify as well if you're interested in learning more about the qualification process to become a passive investor. So why did we start People's Capital Group? Let's go over this real quickly, how we started, why we started People's Capital Group, what was the need, and where's our passion here. Seth Martinez and I, who both own People's Capital Group. So when I looked at the real estate syndication space around 2012 or so, I realized that real estate was not as easy as a lot of the gurus said. I went to a seminar, a guru seminar, and they said, buy a bunch of real estate, put your feet up, and watch the cash roll in. So I did that. I bought a bunch of real estate, and by about unit 12, I realized it was not passive income. In fact, it was far from passive income. I was working very hard as a realtor, about 60 hours a week, and doing well there. But then I had these properties I was buying and managing them myself, and it was just tenants and toilets, and I wasn't doing it right, wasn't making the returns I thought I was going to make on paper. I ended up hiring a management company. They didn't do very well. Ended up cycling through about 3 management companies before we started our own in-house property management company, which has really made all the difference. At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth. So find out if you qualify at peoplescapitalgroup.com. So we started People's Capital Group because many people want to invest and build wealth in real estate, but do not have the time or experience to do it properly. I realized that, holy mackerel, even managing a management company, it takes a lot of time to do it right. Finding a good deal, looking at hundreds of bad deals to find a good one. That takes a ton of time. And then, of course, getting the mortgage, lining up the capital, doing the due diligence, and looking at lots of bad deals to find a good one. That takes really the most amount of time. And then managing it long-term with our in-house property management company or managing a management company is a busy process as well. So I realized that, to do this the right way, you actually have to do it full-time, have an in-house property management company. And it's just not realistic for people who are working, even if you're in the real estate industry, to do this all day because it's a full-time responsibility and there has to be a good infrastructure in place to do this properly and successfully. Buy discounted apartment buildings, improve them, and refinance them or sell them. It's not something one can do part-time. So the solution to people not having the time or experience to doing this type of investment properly is a company that helps people invest and build their wealth in real estate. So that's exactly what we created here at People's Capital Group. a nice turnkey solution for people that don't have the time or experience to invest properly in real estate to now be able to partake in high demand real estate here in New Jersey, apartment buildings that are bought for discounted prices with room to increase the rent, increase the cash flow to investors, and allow for a large cash out refinance over time where investors can harvest a lump sum payout of tax-free cash right to their account. We'll kind of break into that tonight as well, how the cash out refinance works, why it's a tax-free payout to investors, and why we choose to do that strategy here at People's Capital Group instead, of course, selling the properties or, wholesaling them or something like that. So our mission at People's Capital Group is to help people invest and build their wealth in real estate. It's quite straightforward. We find that most people are invested in the stock market. In fact, about 100% of a lot of people's wealth is tied up in the stock market. I went to school and they said, hey, at college, get a good paying job, put 10% away in your IRA or, in investments. And over time, when you're 60, you can retire, but put your money in the stock market, pile it away into an index fund, ride the stock market. And maybe if you're lucky, you'll get, 7% a year, 8% a year. You pay taxes on those earnings, of course. And then over time, you can, of course, build wealth. Now, I'm not saying the stock market is not a good place to invest. You should absolutely have capital in the stock market and bonds and different asset classes. But being 100% invested in the stock market is not true diversification. So we do find that true diversification comes when people are actually able to diversify some capital out of the stock market or bond market or use their IRA to self-direct into real estate. And about a third of our investors use self-directed IRAs, but it's a great way to just diversify, whether you're a cash investor or a self-directed IRA, to diversify out of the real estate, out of the stock market and get into real estate. So you're a little bit out of the casino of the stock market that goes up and down, completely out of our control, and invested partially into brick and mortar assets in high demand markets that produce cash flow, tax benefits, and equity growth over time. That's harvested through cash out refinance, which is a tax-free strategy to harvest that equity growth. So who is People's Capital Group? Well, Seth Martinez and I started this company in 2013. I actually met Seth as a realtor. I got started in 2010 as a realtor. He had sold a medical billing company and had a good amount of cash to invest in real estate. I was strapped for cash, but I knew how to get deals. I was the deal guy. So I was able to source great opportunities. And we bought a 6-family together from a We Buy Houses sign I stapled to a telephone pole for about $220,000. We bought this 6-family property. We put about $50,000 into it and refinanced all of our capital right back out in about a year, allowing us to move on to our next investment. From there, we started a real estate investor association that now has grown to over 4,000 members. And we own about 150 units, over about $22 million in assets throughout New Jersey here. Seth and I have completed over 300 real estate closings together as well. We focus on building strong relationships, whether it's with our tenants or our $1 million investors. We also work with investors all through the spectrum. I have some people, school teachers, firefighters, police officers with $30,000 or $50,000 invested with us. Maybe they're self-directing part of their IRA to try and diversify out of the stock market and build some more wealth and create more tax shelters. Or I also work with multi-million-dollar investors that have 7 figures with us, business executives, business owners, other real estate investors as well. So we really work with a whole spectrum of accredited investors investing 7 figures with us, and also sophisticated investors, people that are not yet accredited, hardworking Americans, school teachers, police officers, firefighters, business people looking to build their wealth and diversify out of the stock market into real estate. So we have all types of people invest in real estate, not just millionaires, not just accredited investors, but also non-accredited, sophisticated investors that get started with a minimum investment amount of $30,000. So we really pride ourselves in working with the whole spectrum. And that's why People's Capital Group works with people to help them build their wealth in real estate. So our limitations on investing in real estate are lifted for qualified individuals. Of course, you do have to meet one of those 2 categories, as a sophisticated or accredited investor. And I'll kind of break into those a little more and those definitions in this presentation. So there's me on the left, Aaron Fregnito. I focus on client relations. We do a weekly podcast. We have webinars almost every other week. We do networking events. We have one coming up January 10th at the Jersey Cyclone Brewery in Somerset. So if you haven't checked that out, be sure to join up with us and get on our mailing list so you can get a ticket to that event coming up. I focus on really being very communicative with our investors and transparent. I send out email updates every single month telling investors exactly what's going on with their investment. If they're invested in multiple projects, then they'll get multiple updates in the month for each project. We send out quarterly financials every quarter so investors know exactly what's going on with their capital, the balance sheet and loss sheet, distribution sheet to see all the investors in that project and how much they're getting distributed that quarter. We send out cash flow checks on a quarterly basis and large lump sums upon refinance. And of course, at the end of the year, investors get K-1 tax forms that allow them to get tax depreciation from these properties as they own the real estate, just like any real estate owner does. And that means they get tax depreciation to write off their cash flow. And when we harvest the equity with a refinance over time, that's a big lump sum payout for our investors that's tax-free, as long as they stay invested in the opportunity. So it's a really good strategy for investors to pay themselves in quarterly cash flow. And a lot of our investors are like doctors, lawyers, high net worth individuals that make a very nice earning and get nailed on taxes. And those people want to make sure they don't have to pay more taxes on the earnings from their investments. So our investment strategy is really a tax strategy. It allows people to invest in real estate, diversify out of the stock market, and know that their capital is hard at work in high demand real estate, but also know that the strategy and the structure of the investment should create no additional tax burden. And people like that because it's about what you keep, not what you make, right? And when you pay a lot of money to the IRS, it feels good to not have to pay more to them when your investments do well. So that's one of the things we like most about real estate. There's Seth Martinez on the right. He handles operations. Seth oversees due diligence of acquisitions, does the initial due diligence of new opportunities coming in the door. He manages our management company and oversees the general operations of the business. I'm more forward-facing, client-facing here. I focus on marketing, branding, educating our investors, and doing all these fun things, podcasts, the webinars, the events. I speak at events almost every single week. So maybe you see me at different RIAs, real estate investor associations, or different realtor events or things like that. So I really try to get out there. Of course, if you're looking for speakers, you're looking to get on a pod, you think you'd be a good guest, or just teaming up on our webinars in different ways. I've teamed up with lenders and realtors and investors and tax specialists, attorneys, other real estate investors. So if you're looking to also get more exposure and learn how we team up with other groups, get in touch with us. I'm an open book. I love building our brands with other companies. And you might be surprised how open we are to doing business on the marketing branding front with you in many different ways. So investing in People's Capital Group is not just a way to build your wealth. Of course, does that, but it's also a way to remain educated with real estate investment, local market updates, and be connected to like-minded individuals that are looking to build their wealth just like you in real estate in different ways. So a lot of our networking events allow our investors to rub shoulders with very interesting, like-minded individuals. And there's a big benefit to being connected to a network like that. So we really try to do more than just give our investors a nice investment opportunity, good returns. We like to bring even more to the table than that. Okay, so let's break into our case studies here tonight, as the topic of this presentation is the current updates on our projects here in New Jersey. So we're going to focus on 4 projects here in New Jersey. Seth Martinez and I have done over 300 real estate transactions together. So we have done a lot. We've done 9 real estate syndications, over 50 fix and flips, over 100 wholesale properties. So really done a breadth of experience here in real estate together, Seth and I. But let's zero in on this building here. This is 465 Summer Street in Paterson, New Jersey. You can see to the left here, this is how we renovate our bathrooms. We really keep a very common style for our bathrooms, that kind of black and white look with the subway tiles, very clean look. We don't break the bank here, but we create a nice product that's very enjoyable. All the amenities investors are seeking, but also the finishings and the cosmetic finishings that tenants are seeking for that type of unit. So we make our units very nice, but of course, we try not to break the bank, but you want durable materials and $1 for these units, of course. You can't just remove a tenant from an old outdated unit and think you're going to get top market dollar for the unit when you release it if you don't improve the unit. So we do physical renovations to these units, move out. We lease those units for more on the open market, and we work with existing tenants to improve some of the issues in their unit right now and increase the rent by generally a smaller amount. So there's two ways we increase rent on a building. As the tenants move out, we'll renovate units and lease it up for top dollar, or we'll work with existing tenants sometimes, fix that leaky dishwasher or issues within the unit, and then ask for a rent increase as we have fixed those units and improved their units slightly as well. But this unit, this property is a mixed use building. That means it has storefront and apartments above it. In this case, so we have 10 apartments and one storefront. So it's not a huge building for us. It was a nice acquisition we did about 2.5 years ago here. The rent was 30% below market value at the time of purchase. We actually snagged this deal from a yellow letter campaign. Okay, those are the little yellow letters that come in like party envelopes that get opened very nicely. And so we got great results from this a few years ago. We still do yellow letter campaigns, and we're starting to get results again from that, but we do different marketing strategies as well. See, marketing is not about a silver bullet mentality. It's really about casting a wide net, having many different marketing strategies. Whether we're finding a next opportunity or raising capital, marketing is about being out there in many different fronts. But in this particular deal, we did source it from our direct mail campaign. The units had been repositioned ahead of schedule, so we bought the building for a discounted price, about $975,000. The units were improved and repositioned and renovated ahead of schedule, so we were able to work out an amicable exit for a number of tenants. There's a couple of non-paying tenants that ended up in eviction court, but most of the tenants that moved out were amicable exits of tenants just moving out as their lease comes and expires. And that allows us to renovate the unit then and lease it up for what the market is bearing for top dollar. So we were able to complete those renovations and turn over those units and negotiate some existing leases as well with some existing tenants up to a higher amount. And by renovating units and leasing them up for top dollar and renegotiating current leases with some existing tenants, we were able to increase the rent roll by our target amount and achieve our cash out refinance in a 2-year period. Right. So generally, we are planning on refinancing these buildings over about 5 years. We give ourselves a 5-year runway, which is really a long time. It generally takes about 3 years to reach this refinance point. See, we're not going to refinance the building until we think we can get about half of our investors' capital back at the refinance. So, of course, there's a target amount we're trying to increase the building to. We increase the building value by increasing the rent roll on the building and lowering our expenses as well. But by increasing the rent roll and lowering our expenses, we improve the net operating income of the building. As we improve the net operating income, that forces the value up. And that's how we force equity into the building. Equity is the difference between what the property is worth and what is owed on the mortgage. So as we buy it for a discounted price, we improve the building, leased up for top dollar, improve our net operating income. We force equity into the building and we force the value of the building up. And then we harvest that equity growth through a cash out refinance. Now, the best part about this is we're not selling the building and losing our cash flow machine. We're not selling the building and losing our tax depreciation machine. We're simply refinancing. We're taking out a larger loan amount. Now, it's a safe amount of debt. The bank's not going to allow us to take out more than the building can handle. There's an underwriting process, and the bank will simply lend you whatever the property can handle based on a debt service coverage ratio. So the bottom line is it's a safe amount of debt at as low an interest rate as possible. Now, of course, as rates raise, we are looking to pause on refinances. We're continuing to increase the value of our buildings and reposition them and force the value up and force equity into our buildings. But that doesn't mean we have to refinance. We can refinance perhaps in 2024, and when rates come down or something like that, we don't have to refinance in a high rate environment. But it's nice to do it more quickly because the faster we do it, the better return on investment our investors enjoy. However, as we continue to reposition buildings and improve, high interest rates really are just going to delay the refinance. We're going to continue to push the value up on the building, and that equity growth will be harvested down the road. So it's really not like our investors lose any money if we don't refinance the building sooner than later. It just means they're going to have to wait a little bit longer to get that lump sum tax-free payout, which of course is a challenge of investing, but we always try to get there as quickly as possible. So on this building, we achieved our refinance value in 2 years. We went ahead and got the property appraised. We were able to successfully obtain our refinance appraisal value, harvest the equity growth in the building. and achieve a 24% annualized cash on cash return to our investors. That means if you made a $100,000 investment in this property, you'd expect $50,000 back by year two, by the end of year two in this case, allowing for about a 24% annualized return on investment here, cash on cash return. Now, at that point, at that refinance, investors have the option to exit. They can get back their initial investment, keep the funds earned from cash flow, keep the funds earned from the refinance, get back their entire initial investment, but then they're going to have to pay capital gains tax on those earnings. So a better tax strategy, and what about 90% of our investors choose to do, is remain invested long-term, continue to get quarterly cash flow checks from the property, continue to get a large lump sum, about 50% of their initial investment at each refinance every 3 to 5 years, and then of course avoid all capital gains tax on those earnings. Maybe one day down the road, we do sell through a 1031 tax deference. We defer all taxes and trade into a bigger property. And that allows our investors to keep earning wealth, keep building wealth, keep earning cash flow into a bigger property as well, and exponentially build their wealth. And that's called generational wealth. That's the idea most investors have with us. And that's the mindset we share with our investors. And we like to impress upon them is that, hey, keep your principal at work. Keep building wealth with your principal investment. The $50,000 or the big lump sums upon the refinance, yeah, listen, that cash, go to Disney World, go enjoy it, right? But don't burn up your principal going to Disney World, right? Invest your cash, invest your principal, make returns. And then if you want to enjoy those returns, go and enjoy those returns. If you want to build a lot of wealth, take that big lump sum you make upon the refinance and reinvest it into another opportunity, which the majority of our investors do. But of course, life isn't always that simple. Sometimes you need the cash for different expenses, of course. But the whole mindset here is to invest that principal, keep that principal at work, keep building that wealth long-term, and eventually hand down that wealth as it grows and grows and grows tax-free down to your heirs as generational wealth. And that's my plan. As I have a 1-year-old son, I build my wealth very aggressively. Here, I invest in these opportunities myself personally. And I love building my wealth in real estate. And I love structuring my assets so I can hand them down to my heirs one day, completely tax-free. Essentially, I'm going to swap till I drop. I'm going to buy real estate, improve it, refinance over time, cash flow, and eventually swap through a 1031 tax deference, sell some buildings, smaller buildings, maybe trade into a much bigger building. We'll sell this 11 unit and 25 unit and 27 unit, maybe 12, 15 years from now, trade into a bigger building and take our investors, if they choose to join us, of course, there are also exit options along the way. But that flexibility is nice for our investors. They can exit multiple times or they can build generational wealth with us long-term. So, of course, we achieved returns of 2 times greater than initially targeted on this 11 unit here because we initially targeted a 12% annualized cash on cash return. In fact, we almost always pretty much target around a 12.5% annualized cash on cash return. That's generally our target. If you follow us, you'll see that consistently. But of course, we did 2 times that on that offering. Okay, let's break into another property here. Again, if we have questions as we go along, I see more people are jumping on, which is really awesome to see. Please put your questions in the Q&A or the chat. I'll answer everything at the end here. Let's break into another property. This is 196 9th Street in Passaic, New Jersey. Got a bit of a smaller property, but a good example of a very successful reposition here. And yes, you can syndicate small buildings like this. We've managed to do it on a pretty affordable budget, and that allows us to keep our costs low and syndicate small buildings like this. So it's a 6-unit residential apartment building. We purchased it for $450,000 in 2019. It's a great price, by the way. And this is a nice building here in Passaic, New Jersey. We were able to complete the cash out refinance ahead of schedule. So we renovated and leased the units for top dollar. We're not reinventing the wheel here. Same strategy with all of our properties. We have an in-house property management company. Our infrastructure is in place to buy these properties for great prices. We have great relationships with brokers and wholesalers and landlords and marketing techniques to get buildings at discounted prices, just like we did here, direct to the landlord. And we also have an in-house property management company that allows us to renovate them faster, lease them up for top dollar faster, find quality tenants and make sure we're not leasing to low quality tenants that are just going to end up in eviction. And that allows us to complete these projects faster, more aggressively, and force the equity more aggressively on these buildings than being at the mercy of a third-party management company, which most real estate syndication companies are at the mercy of. See, we actually hired and fired 3 management companies before we developed our own property management company in 2015. And it's been our greatest asset ever since. It really has. We realized that you can make money in real estate, flipping houses, wholesaling, buying warehouses, investing in Florida, Texas, New Jersey, California, Arizona, you name it. There's lots of ways to make money in real estate. None of them are right or wrong. But at the end of the day, the most important thing is the operations. If your operators don't know what they're doing, they don't have their ducks in a row and their infrastructure in place, they don't have a good track record, then you really should be investing with them. It's all about the operators. There's tons of different markets with opportunities and data and different ways to analyze markets. There's people that make a killing in warehouses. There's people that do self-storage. There's people that own, 3,500 multifamily units and never have to work again, right? So there's lots of ways to build wealth in real estate. None of them are right or wrong. It's all about the management system. Now, we like multifamily housing because people need a roof over their head. So through recession, they tend to hold their strength and hold their value very nicely. We also like multifamily real estate because there's a good amount of them here in New Jersey. We have had great success with them. And there's just so much demand here in New Jersey. There's such a shortage of housing. It takes a lot to build new housing here. There's a lot of red tape. There's a lot of restrictions. There's very high costs to building new housing. So they're not really building enough housing to keep up with the demand here in New Jersey. And you hear that problem throughout a lot of states in the country. And because of that, we have great success leasing our units for higher than initially targeted. The hardest part of our job is finding a good opportunity for a discounted price with value add, meaning rents are below market value. We can increase them over time to force value into the property and then harvest that equity growth for our investors over time. So in this building, it refinanced and appraised for $730,000 3 years after buying it. So we purchased it for about $450,000. We invested about $60,000 in renovations, $50,000 to $60,000 in renovations. We leased it up for top dollar. Then it appraised 3 years later for $730,000. So we were able to do a cash out refinance, get back about half of our investors' capital at that refinance in 3 years. So this investor earned about 1.5 times our initial target, about a 16% annualized cash on cash return these investors earned on this property here. And that's about 1.5 times our initial target. The property produces cash flow as targeted. And investors achieved returns 40% greater than initially targeted. Yes, so roughly 1.5 times that. So really successful investment here for our private investors, and got that for a great price. Of course, you make your money when you buy in this business. You always want to buy for the right price, which is very hard to do in New Jersey. All right, let's break into another building here. Here's a third of 4 case studies. So this is 105 Marion Street in Paterson, New Jersey. These are 25 residential condos that are currently under renovation and repositioning. We're working to get to our refinance point now on this property. It was purchased in October of 2020, so kind of at the height of the pandemic. It was a pretty wild time to be buying real estate, although real estate prices were kind of shooting up then, and we had locked it up right before the pandemic. It was a very long closing due to the pandemic. And so we had it kind of for a pre-pandemic price. And so it actually panned out very nicely for our investors and us here. So rents were roughly 15% below market value when we bought the property. Rents in Paterson have really skyrocketed. So it's now rents are really, the initial rent roll is probably 35% or so below market value since rents have grown so much in that city. Our renovations are on track and on budget. So far, so good. We are looking at being able to achieve this refinance probably about 3 years into the investment. Now, we are going to have to keep an eye on interest rates, of course, in 2023 here and consider where they are at towards the end of 2023. But with a little luck, if rates come down, this building should be ready to refinance around the end of 2023 or early 2024, which would put us ahead of schedule by about 2 years in this building. So, of course, we'll wait to see where rates are at that point and make a judgment call. We don't want to be short-sighted, of course, and refinance into a high rate just to be able to cash out a bunch of equity and pay our investors a big check. Our investors would like to get paid, of course, but I think it would be short-sighted as operators to lock in a high interest rate. We'd be better off as rates are coming down to just wait a little bit, keep building equity into the property, and harvest even more equity growth a little bit down the road. So in this case, as I said, our renovations are on track. Our rents are even further below market value now, so we're increasing them even more aggressively. We did a tax reassessment and saved $13,000 a year on taxes. So another way to build value into real estate is not only increase the rent roll, the forms of income on the property as well, like parking, storage, and laundry, but also recognize how to lower your expenses, right? By saving $13,000 a year on taxes, that goes right to our bottom line. That improves our profit and our cash flow to our investors by $13,000 because all of our other costs are already covered with the rent coming in on the property. So every dollar I can lower my expenses by goes right to the bottom line for investors and also exponentially helps the value of our building. See, because the way these buildings are analyzed and appraised when we go to refinance is the appraiser is going to take the net operating income, right, the amount of income coming from the property after expenses but before debt service, and divide that into the market cap rate. Now, cap rates fluctuate, but for the most part, we buy in pretty high demand markets and nice pieces of real estate and pretty low cap rate, meaning high demand market areas. So as that net operating income is divided into the cap rate, it's an exponential increase in value when the cap rates are around 5 to 6%, which are the markets we invest in. So it's an exponential increase in value when I increase the rent by $1 or lower the expenses by $1. That increases the value of our building by about $1.50 or more. All right. Because of the way the real estate's appraised, a single dollar increase in revenue allows us for a multiple increase in the building valuation. So as we increase the rent roll on the building and lower our expenses, not only does it allow for more cash flow to the investors, but it also allows us to force an exponential amount of equity growth into the property. And of course, we harvest that equity growth with the cash out refinance over time for our investor group. So the final 4 units are being repositioned this year. One of the biggest challenges we're having with this building is removing existing tenants. See, there is rent control in this building, in this market. So when leases expire, very low priced leases, we choose not to extend those leases and renew those leases. We instead choose to not renew the lease and give the notice to the tenant to move out. But of course, in areas like this, it is more challenging than that to have an amicable exit of tenants. So right now we're looking at different legal options, but we're probably going to consider a cash for keys with some of these tenants as well, which isn't the end of the world. A lot of times paying a tenant $2,000 or so to move out or something like that could be a great strategy in the long run. As say a tenant's paying $1,100 a month, we know we can renovate their unit for about $15,000, lease it up for about $1,900 a month or something like that. And that increase in rent not only is going to, not only are we going to make back our renovation cost in the first year by that increase in rent, but the building now is going to be worth exponentially more than we've invested into the building because of that calculation I just explained. So as we renovate these buildings, every dollar we put into it to renovate it is an exponential return on investment for our investors. And that's really the magic of repositioning apartment buildings with low to mid cap rates. Because as you increase the revenue on them, you exponentially increase the value of them, and that allows for a very profitable cash out refinance. And of course, the cash out refinance is a tax-free liquidity event for our investors. So it's just an amazing icing on the cake that not only do you get to cash out a large amount of equity pretty quickly on these buildings, but also it's tax-free as long as you remain invested in the opportunity with your initial principal. So this is on track to refinance ahead of schedule. It's on track to provide passive returns greater than targeted to our investors. So far, so good on this one. Again, the biggest challenge is working low-paying tenants, working out an amicable exit of those tenants, an amicable and legal exit of those tenants, which first we try to not renew the lease, give the proper legal notice, thing, we try to go to the court and explain that we need to renovate the unit. And because of that, the tenants do need to move out with proper notice. Of course, if those options don't succeed, then we work out a cash for keys with the tenants. And that's a good tip of the trade to try kind of those three avenues to exit a tenant that's very low paying in an area that does have rent control. Okay, 190-200 West Milton Ave in Rahway. So let's talk about this one. We have about 25 investors in this or so. And this has been a very successful property for us here. So this is a nice building we bought for about $2.75 million. It's about 2 blocks from the train station in downtown Rahway here. We have a good amount of investors participating in this opportunity. This building produced cash flow from Q1 of ownership. It continues to produce cash flow equal to the, or actually a little greater than the initial targeted cash flow amount. We are doing about $350,000 in renovations to the building. And we purchased it in December of 2021. So really just, about a year ago here. And rents are about 30% below market value when we bought the building. Rents have gone up even more. We're leasing units for about 15% higher than we initially targeted. See, when we underwrite a building, we want to be very conservative, right? When you go to bat, you're not going to tell the coach you're going to hit a home run every time. You say, listen, I'm going to strike out a few times on some singles and doubles. Maybe now and then I hit a home run, right? A good batting average is like a 330, right? That's phenomenal. So you want to understand also when we do renovations here, we do repositions for apartment buildings. We want to manage our investors' expectations. We want to underpromise and overdeliver. That's why about 90% of our investors decide to reinvest with us over time, because we really try to underpromise and overdeliver. So when we tell investors, hey, we need 5 years to get to a refinance, and if we do that, you'll earn a 12% annualized cash and cash return. Or we tell investors, hey, we need 2 years to create positive cash flow on this building. We understand that that's a very long runway for us, and it's much more likely that we're actually going to produce cash flow much faster than that, generally in the first 6 months of ownership. It's much more likely that we're actually going to achieve that refinance in about 3 years instead of 5 years. But we don't know where the market's going to do tomorrow. We don't know where interest rates are going to be. We don't know if we'll have a lot of problem tenants or open up some walls and find issues. And so at the end of the day, we want to make sure we have room in our budget for unknowns, also room in our timeline for unknowns, right? Because there's two things when you're talking to someone about investing your hard-earned capital in their opportunity. There's two things that you need to know, right? How long am I going to, what's the minimum investment period generally that I need to be invested in this opportunity, right? Because you want to know when your exit options are. And also, how's the capital secured, right? How's my investment secured on top of what returns I'm going to make? So it's very important to understand that. And it's very important to understand that when we structure an investment, we really assume very conservative assumptions. We assume inflation goes to 1% long term. Now, the 100-year average of inflation is 2%. We assume, for example, the building in Bayonne we're buying right now, that rent stopped growing for 3 years. Rent probably isn't going to stop growing in Bayonne, New Jersey for the next 3 years. I'd kind of be surprised personally if it does. But we want to make sure we have that window time in case the market does drop out. We assume interest rates are going to be high until about 2024, right? We don't have a crystal ball. All we can do is take all the data we have right now and make the best educated guess we can for our investors, and then assuming right that the market's going to do worse or things are going to be slower or tougher than we assume, right? Because we know that what can go wrong will go wrong, right? Murphy's Law. So we want to avoid that. We want to give ourselves a nice runway to get to the things we're trying to get to, that cash out refinance, right? Achieving positive cash flow, right? All these things take a little time. And by giving ourselves that runway, we underpromise and overdeliver to our investors. And that's one of the best things that we can do in this business to make sure that we manage our investors' expectations properly. So this is 2 blocks to the train station, this building here. You can see the pictures to the left there. We've done the same types of renovations to these buildings. Same type of black and white subway tile there. The black and white bathrooms there, nice clean look. Subway tile there. We also have a nice clean kitchen there with the white cabinets, stainless steel appliances. You can see that flooring we use. That's Pretty common Home Depot flooring there, but nice and clean, very durable, great for rentals. And then you'll see the picture there, front and center, of the old bathroom. Right? That's the original bathrooms. That's how bad they were. So this building was in pretty rough shape. We've been on budget with our renovation. We've been ahead of schedule with the renovation as well. And we're on track to refinance ahead of schedule. The property growth, we've been forcing the equity up faster than we initially targeted. Units are leasing for more than we initially targeted. And we should be able to refinance this building next year. That would mean we'd be able to refinance the building about 2 years after purchasing it. Now, of course, interest rates are going to play a role when we decide to refinance this building. The last thing we want to do is be short-sighted, right? And then try to pay our investors and ourselves early. That would be selfish and short-sighted and irresponsible. So we want to look at our interest rates come next year. We want to make a judgment call, and if it's the right time to refinance. And of course, the rates at that time will give us more information. Now, if rates are very high next year, which we kind of expect them to be, then we're just going to keep repositioning the property, keep renovating the units, keep leasing them out for top dollar, and forcing value into the property and building the value higher and higher and higher on the property by doing all those avenues. And then we're going to harvest that additional equity growth through the refinance maybe the year after. So yes, there'll be a little bit longer waiting to complete that cash out refinance and get that check into our investors' account, but it should be a larger amount at that time if we wait longer to do it. And of course, that's all tax-free payouts to our investors if they decide to remain invested long-term. So this has been a very successful opportunity here for our investors so far. We're very excited to get to refinance on both the 25 unit I just talked about and this 27 unit here in Rahway as well. Looking forward, our next opportunity is a 21 unit in Bayonne, New Jersey. We're buying this as an off-market deal. It was brought to us by a broker we know very well. He said, hey guys, I have a family-owned property. It's in great condition. It's very well maintained and well managed. Rents are about 35% below market value. So they just basically forgot to raise the rents for the last few years, but they've been maintaining the property very well, which is actually not what we commonly find. We often find if rents are way below market value, there's a lot of deferred maintenance throughout the property, which can add up. We saw that in the Rahway property for sure. So in this opportunity in Bayonne, New Jersey, it's a really nice building. You can see the pictures below the lobby. It's kind of that pre-war style. The units themselves are actually very well kept and very nice. Rents are simply 35% below market value. 75% of the building is free market. Bayonne is much more landlord friendly than Jersey City or Hoboken. When a tenant moves out, there's 100% vacancy decontrol. So we can increase the rent to whatever the market is bearing. And also for the 16 free market units in the building as well, there's no rent restrictions on those units. We assume that tenants living in the 5 rent-controlled units will never move out. We assume those rents will increase at CPI, basically, or a few ticks below it. But hey, if those tenants do move out over time, which actually in my experience, even for rent-controlled units, maybe every 5 years, you do get tenants to actually move out of those units because they just get tired of living in them. That could be icing on the cake for our investors, but we, of course, don't even assume that. There's also other tricks to the trade for this building. For example, there are some 1-bedroom units, about 3 or 4 of them, that could be easily turned into 2-bedroom units because there's a dining room, living room, and kitchen. And the dining room, quite frankly, is used generally as another bedroom anyway. So we convert that dining room into a separate bedroom, and that gives us 2 bedrooms, a living room, and a kitchen. And of course, we'll increase the rent roll by a good amount there for a very small investment. You're essentially putting a closet into a room and increasing the rent by hundreds of dollars a month. So great return on investment by doing that trick of the trade, turning a 1-bedroom into a 2-bedroom. And sometimes that's possible depending on the layout of the unit. So this is a great opportunity. It's 3 blocks to the water. It's a 10-minute walk to a light rail station. They're building a ferry that goes from Bayonne to Manhattan. And it's going to increase or decrease the amount of time it takes to commute into Manhattan from Bayonne. Bayonne is right below Jersey City. It goes Hoboken, Jersey City, Bayonne. It's right there on the Gold Coast. It's a very high demand market. Beautiful building, well-maintained, classic situation with rents below market value. But the pride of ownership on this building is very nice to see, which we often don't see in a lot of our buildings. So that's coming up with us here at People's Capital Group. If you haven't yet checked out that opportunity, I'm going to explain here in the next few minutes how to get qualified and how the process works. So here at People's Capital Group, we've helped over 100 people invest in real estate since our inception in 2013. We bring a solution to people for investing in real estate. Like I was saying, we work with people in the industry. We also work with people out of the industry. Really, a lot of our investors actually also own real estate. They might be own a couple duplexes or a number of properties. They might own more properties than us, but they're getting to the point where they're tired of managing them or managing a management company. They're getting the retirement age and they've done well for themselves. They know real estate, they understand it, they trust it, but they're just really not able to manage all their assets anymore long-term. And the passion for that has gone. So many active investors also look at passive investment opportunities as they get to a certain time in life and they start to slow down and enjoy their money and invest it passively in apartment buildings with us. And those active investors, the best compliment I get is, hey, you know what? I'm earning as the same amount on your passive investments, even though I'm getting a small piece of the pie and sharing the pie a little more, but I'm earning the same return on investment with your properties that I am for the properties that I own 100% of and manage day in and day out. And wow, what a nicer experience to be invested passively, not have to do anything, get monthly updates, quarterly financials, quarterly cash flow checks, K1 tax returns at the end of the year, big lump sums upon the refinance, and earn the same return on investment that they're getting on the properties that they're managing themselves and own 100% of and had to sign the dotted line for the mortgage on and so on. So it's really quite a compliment when active investors say, hey, I'm actually earning more or an equal amount on the properties I own with you that I own myself. I'm going to just sell my properties and invest more with you because the return on investment is there and the experience is more enjoyable. And number three, of course, our highest values are integrity, confidence, and peace of mind. We want to make sure our investors know that their capital is hard at work in high demand real estate with confident operators who have a good track record, who do the right thing, communicate consistently. And also here at People's Capital Group, we're a lean, mean company. So I'm a phone call away, I'm a text or an email away to get answers to your questions. My monthly updates are very in-depth. It should answer all your questions. But of course, if you need more details, you can always contact me as one of our investors. We are an open book. We are transparent. We're very fast to communicate. You can ask our current investors that. So here's the process. First, we determine your real estate investment goals. We want to set up a call, discovery call, okay? That's about a 15, 30-minute call between you and I. We're going to talk about your investment goals. We're going to explain how the process works here in a little more depth, although this presentation has explained a lot of it. We're going to see if our investment goals align, and we'll talk about what we have coming up as well and what that investment would be like if we do have something available to invest in. The second step is to contact us to share your goals and apply that investment. We'll then introduce you to our investor platform. Once you're approved to invest, you can sign on to our investor platform, fill out a qualification form, and we'll mark you as qualified there. And then you can review our current investment opportunities, see if they're fit for your investment goals, and also set up probably another call with me to answer your questions after you review the offering and the information there. Once you're approved to invest, you can go ahead and do that all right online. We make it very easy. You start your account online, you have your investor dashboard, just like Vanguard or something like that. You can log on anytime, check it out, your projects with us, your return on investment, get access to your updates, your quarterly financials, your tax returns. Of course, those are all emailed to you as well, but you can also get access to them anytime on your investor dashboard. So we make it very easy to invest with us. All the documents are signed right online. The updates are emailed to you and everything's done really right online. So it's a very easy process. You don't have to print out paperwork and sign it and get things notarized or things like that. And then, of course, step 4, begin building your wealth, right? Deposit your quarterly cash flow checks, open your monthly updates, learn more about your investment and real estate investing in general and property management. And then we'll update you. We'll give you first shot as a private qualified investor with us at upcoming investment opportunities. Some of our opportunities we don't even send out to our general email list or social media because they get funded so quickly internally with our group of current investors. So it's important to get qualified, get on our investor list, even if you're not ready to partake in this opportunity in Bayonne, New Jersey that we're closing on early next year. You can still get qualified, set up your discovery call, get that process done so you're qualified to invest with us and you can get the jump on upcoming opportunities. So even if you're not ready to invest, even if you're on the fence, it's important you schedule that call with me, Aaron Fregnito. We start the process, see if you're qualified, get you on our qualified investor list so you can at least review opportunities as they become available, learn more about them, and maybe one day you'll find an opportunity with us that is a fit for your investment goals. Here's some testimonials from different investors. Here's Robert, 8-time investor. I've invested numerous times with People's Capital Group over the last 6 years. I'm happy with my investments. Rita, 3-time investor, very satisfied with my investments at PCG. I've been able to sell my rental property and no longer be a landlord. It's a very common story we get with investors. Yet I'm still making money in real estate thanks to PCG. Here's Chris S., a 6-time investor. I've been investing with People's Capital Group for nearly 5 years now and could not be happier with the process and the returns on my investment. Aaron and Seth and their team have been great to work with. They're like clockwork in their updates, communications, payments, a great company. Here's Frank B., 4-time investor. My investments have been on the mark and I like not having to manage the properties. Tim C., 6-time investor. I continue to grow my investing relationships with Seth and Aaron. They have a great history of buying properties at a good price and offering me value. Gary C., 7-time investor. My confidence in Seth and Aaron has been rewarded with professionalism and wise investments since I started investing with them in 2014. So the first step in getting qualified is scheduling a call with me, Aaron Fregnito. Tonight, we talked about 4 different properties that we're working on right now. 2 of them we've successfully refinanced. One of them achieved a 2 times initial target return to our investors. The other returned about a 1.5 times our initial target return to our investors. And of course, the 2 other projects we went over were bigger buildings that we're in the midst of repositioning right now. And they're ahead of schedule, on budget, and looking to be ready to refinance next year. Of course, based on interest rates, we'll make a decision at that time. But the bottom line is the projects are ahead of schedule and they're set to make returns to investors that are way ahead of target. So we're located in Somerville, New Jersey. I usually like to set up a call first to get to know our investors, do that discovery call, and learn more about your investment goals. We're having an event January 10th at the Jersey Cyclone Brewery in Somerville. So you're more than welcome to join us there. But here's what I'm going to do. I'm actually going to take this link here and I will put this in the chat so that our people listening and following us here can actually schedule that call with me right now and get on my calendar. Now, my calendar does fill up very quickly. So especially with the holidays coming up, I am going to be away from Friday of next week to the day after New Year's. So I'll be out of town for that week and a half or so, as most people are that time. However, I do have some availability towards the middle of next week. So if you want to click that link I just put in the chat, go ahead and do that now. And you could schedule a call with me, Aaron Fregnito, I can learn more about your investment goals and your questions about how we help people invest in real estate, how we buy, renovate, and refinance apartment buildings can be answered in that call. And I'll talk to you more about the qualification process as well. Now, if you're not sure if you qualified, we work with accredited and sophisticated investors. I told you I would define what that is. So an accredited investor has a net worth of $1 million, not including their primary residence, or has a $250,000 individual income or a $300,000 income, including their spouse. Now, most real estate syndications only accept accredited investors. We also accept sophisticated investors because we're People's Capital Group, and we help people invest in real estate. We've been doing this over 10 years here to helping people invest in real estate. So we also accept sophisticated investors. Those are people with the mental capacity to understand the risks of the investment, some experience analyzing or investing in real estate in the past, and don't need to live on the returns of the investment, okay? They don't need to live on the cash flow, or they're not investing their last $30,000 or something like that. But many people self-direct their IRA or their solo 401k into real estate. If you haven't yet learned how to do that, we have webinars and information on our website, peoplescapitalgroup.com. So go to peoplescapitalgroup.com and learn more about the IRA self-direct process there. We also have webinars on our YouTube channel. But about a third of our investors self-direct their IRA. So if you're curious how to do that, maybe you have a solo 401k or a 401k you want to consolidate and then move into an IRA and then move into an investment, let's talk. I know how to do that. I know IRA custodians that can help you do that. We can help you with the final process of then once you select your IRA custodian, the asset you want to invest in through that IRA custodian, People's Capital Group can assist you with that. And of course, I've been doing this for many years and helping many people invest and self-direct their IRA. So if you have questions about that, let's schedule that call. Let's connect. If you're looking to build your wealth and you're not sure if you qualify, you're not sure there's a good fit for you, or you're just not sure on the returns or really how the investment experience would work here on this 1 hour presentation, then go ahead and schedule that call. Let's connect. Maybe you're not even ready to invest. You're thinking, oh, I'm not going to be ready until next summer. So what's the point? Schedule the call. Let's connect. Let's get to know each other. Let's get you qualified so you can review upcoming opportunities. Because quite frankly, if you want to invest in 6 months, you should start talking to that company now. Get to know them, learn their strategies, learn their morals and ethics, learn about their track record, start reviewing their current opportunities. So then when you're really ready to invest, you'll be able to see what the opportunities are like. You'll be familiar with them. You'll be able to recognize good opportunities. So whether you're getting started in your investment journey or you own millions of dollars of assets and you're looking to now maybe take a back seat, work a little bit less, but keep earning income through real estate, you want to diversify into some passive opportunities, let's schedule that call. Let's get to know each other. Let's start building our wealth together in high demand real estate here with People's Capital Group. So I hope we can connect. I don't see any other questions here on the Q&A, but it looks like we had a great turnout tonight. So thank you everyone for joining us. I'm going to actually leave this chat open for a few more minutes after we conclude here. So you can click that link in the chat to schedule a call with me, Aaron Fregnito. I look forward to connecting. Have a good night.